Welcome to Girl Investors. If you do not know who Warren Buffett is, what value investing is, or how to interpret financial statements, you have come to the right place. In this three-part series, we will take you through an in-depth summary of Warren Buffett and the interpretation of financial statements written by Mary Buffett and David Clark. In part 1, we will teach you the criteria Warren uses to select companies with a durable competitive advantage and how he dissects his income statements. So by the end of this video, you will be able to tell everyone that you know that you can read an income statement like Warren Buffett does. How awesome is that? I am the founder and creator of Girl Investors. We are on a mission to improve financial literacy and an investing mindset among women of all ages. If this sounds good to you, then please keep watching. Alright, for anyone who hasn't heard of Warren Buffett, he is the chairman and CEO of Berkshire Hathaway, a company that owns over 60 companies such as Dairy Queen, Geico, and Duracell. He is 89 years young and is one of the world's most famous and successful value investors. In upcoming videos, we will summarize many other books written about value investing and summarize other accounting books because repetition is the mother of mastery, and even summarize letters to his shareholders. Warren is probably the only reason I know anything about Omaha, Nebraska, which is where he's from. It's the language of business. It's an imperfect language, but unless you are willing to put in the effort to learn accounting, how to read and interpret financial statements, you really shouldn't select stocks yourself. Accounting is the language of business. It is a standard set of rules for measuring a company's financial performance. Assessing a company's financial performance is money for many stakeholders, such as company managers deciding to make an acquisition, for investors making investment decisions, and for lenders deciding whether to lend an organization money. For the purposes of this series, though, we will focus on how and why Warren Buffett focuses on certain aspects of financial statement analysis and accounting concepts. In upcoming videos, we will do some accounting basics videos for those of you who this is new for. At its heart, the Warren Buffett style of investing is about improving the methods of his mentor, Benjamin Graham. The two key themes that distinguish his style of investing from his mentor, Benjamin Graham, are how do you identify an exceptional company with a durable competitive advantage, and how do you value a company with a durable competitive advantage? These companies own a piece of the consumer's minds, and therefore they do not have to change its products or service offerings. Warren Buffett has developed a set of analytical tools to identify these special types of businesses. So Warren has figured out that super companies come in three basic business models. First, they sell a unique product. These companies own a piece of the consumer's mind, and therefore it can charge higher prices and sell more of its products because it never has to change its products. Examples include Budweiser, Coca-Cola, and Pepsi. They sell a unique service. Companies that sell a unique service are institutional specific as opposed to people specific. They do not have to spend a lot of money on redesigning its products, nor do they need to spend a lot of resources building production plants or warehousing. Examples include the accounting firm H&R Block or the credit card company American Express. They are low-cost buyers and sellers of a product or service that the public consistently needs. Being a low-cost buyer or low-cost seller allows these companies to get their margins higher than their competitors and still be the low-cost seller of the product or service. Examples of these include Walmart and Costco. These companies have a monopoly-like economics that give them a long-term competitive advantage. Moreover, the underlying economics of these businesses diminished his risk while increasing his potential for gains. When Warren assesses a company's financial statements, he asks the following questions. Does it show consistent earnings? Does it consistently not have to spend large sums on research and development? Does it show consistent growth and earnings? Does it consistently have high gross margins? And does it consistently carry little or no debt? Financial statements are where Warren Buffett mines for companies with the golden, durable, competitive advantage. The financial statements are a record of the financial activities of a business. Warren drills deep into the numbers and reads between the lines to figure out what's happening in the business, perhaps more than the business wants him to know. You might be surprised how many people in business look at financial statements without really understanding the information that it contains. Don't be that person. Pay attention here and review it again if you need to. Reading financial statements are crucial to investing. The financial statements tell Warren if he's looking at a mediocre business or a company that has a durable competitive advantage that will bring him exceptional returns. And if you think about it, how it could bring you exceptional returns. The three key financial statements are the balance sheet, the income statement, and the cash flow statement. I should add that there is actually a fourth financial statement called the Statement of Shareholders' Equity. The authors didn't mention it in this book, but we will discuss it in future videos. An income statement is a report that shows how much money a company has made or lost by looking at the income, expenses, and the resulting profits or losses of a business at any one time. So if we put this another way, the income statement is a statement of profit and loss over a specific period of time, which is typically a quarter or a year, and tells you about the operating performance of a company. The balance sheet is a statement of financial position. The balance sheet reports the company's resources, which is its assets, and how those resources were funded, meaning the liabilities and shareholders' equity, on a particular date, which could be the end of the quarter or end of the year. And along with the balance sheet and income statement, the cash flow statement is a required financial statement that provides insight that the income statement cannot. Specifically, it tells us exactly how much cash a company generates and from what activities. Hey, by the way, if you're enjoying this video and learning something, please click the like button. This will help us a lot. Warren starts his analysis with the income statement. At a high level, the income statement is revenues minus the expenses generate to equal profitability or loss. Easy enough, right? The income statement facilitates the analysis of a company's growth prospects, cost structure, meaning where it has to spend money to generate their revenue, and the components and drivers of net earnings. The first line is the revenue or gross income. To Warren, the source of the earnings is much more important than the revenue itself, because as you will see later on in the income statement, not all income is revenue. The top line revenue by itself doesn't really tell us the whole story, which is why he looks at what the company had to spend to earn that revenue. So we look at expenses. This is also known as the cost of goods sold, or the COGS, or it could be known as cost of sales or cost of revenue for a service-based business, and represents a company's direct cost to manufacture for manufacturers or procurement for merchandisers for a good or service. Direct costs can include raw materials such as steel or lumber, or direct labor costs and factory overhead and so forth. But still, COGS, or cost of goods sold, by itself doesn't tell us everything either. Gross profit margin. The gross profit margin represents profit only after direct expenses, COGS, have been subtracted from the revenues. The gross profit margin tells Warren about the economics of the company. The companies that have a durable competitive advantage have consistently higher gross margins. In general, companies with a gross profit margin of approximately 40% have some sort of durable competitive advantage. Now let's get into operating expenses. If it were only so simple as having to just know about the gross profit margin. After gross profit is considered, we have other expenses commonly known as operating expenses. These are indirect operating expenses and include things like SG&A, R&D, and depreciation, impairment charges, amortization, and so forth. Warren scrutinizes these operating expenses very carefully, and so should you. SG&A, also known as Selling, General, and Administration, are operating expenses that are not directly associated with the production or procurement of the product or service that the company sells to generate revenue. This includes things like management salaries, payroll wages, commissions, meals and travel, expenses, the pens and paper and stationery that the company uses, advertising, and marketing expenses. Warren looks for companies with consistently low spending on SG&A. As a percentage of gross profit, SG&A spending under 30% is considered good for Warren. Companies that don't have a durable competitive advantage have wide variations in their SG&A expenses. So in general, Warren stays away from companies with high SG&A expenses. So keep that in mind. You might have a keen eye and notice that administrative costs are listed under SG&A and not under cost of goods sold. And that's because those are indirect operating costs. COGS, or cost of goods sold, are direct operating costs to manufacture the good that the company sells. R&D, or research and development. Warren also shies away from investing in companies with high research and development expenses. Research and development, or R&D, are a company's activities that are directed at developing new products or procedures. The competitive advantage for companies with high R&D expenses are usually because they have a patent or a technological advancement. So that means when the patent goes away, so does the competitive advantage, as in the case for many pharmaceutical companies, for example. So, for example, Merck, which is a pharmaceutical company, spends approximately 30% of its gross profit on research and development and 49% on SG&A, for a total of 78% of its gross profit on these indirect operating expenses. Warren thinks companies that have to spend so much on these indirect operating costs have an inherent flaw in their competitive advantage and long-term business economics. EBITDA. You may have heard of the acronym EBITDA. EBITDA is the earnings before interest, taxes, depreciation, and amortization. Gross profit minus the SG&A minus R&D. EBITDA is a popular measure of a company's financial performance, which Warren does not like because it excludes depreciation and amortization. Rather, he likes to use EBIT, which is the earnings before interest and taxes, also known as operating profit. Warren's philosophy is that depreciation is a very real expense, as we'll see next. Depreciation is that most businesses need to purchase some equipment, machines, or buildings, all of which have finite lifespans and eventually require replacing. The depreciation and amortization is the systematic allocation of the cost of fixed assets over their estimated useful life. There is more than one way to calculate depreciation, but just to illustrate, let's do an example using something called the straight line method. So suppose a publishing company purchases a printer for $100,000, which has a lifespan of 10 years and a scrap value of $1,000. Scrap value means what the printer is worth at the end of 10 years. But what is the depreciation expense that the company must report on its income statement each year for those 10 years? The depreciation expense is calculated by taking the purchase price, which is $100,000, deducting the scrap value, which is $1,000, and dividing the difference by 10 years. This gives us a depreciation expense of $9,900 a year. So all of this means that the full expense for the printer, meaning $100,000, is not taken in the year that it's bought, but rather it's allocated in $9,900 increments over 10 years. So pat yourself on the back if you got that right. Warren believes that depreciation should always be used in the calculations of earnings. Warren favors companies with depreciation expenses under 10% of gross profit. Interest and bank charges. The interest expense is the amount the company has to pay on debt that it carries on the balance sheet as a liability. This could be to bondholders or to banks. However, sometimes the company could possibly have earned interest income, such as a company's income from its cash holdings and investments, such as stocks, bonds, and savings accounts. Just like you and I, companies can also invest. Interest expense is a financial cost, not an operating expense, because it reflects the debt that a company carries. So what does Warren think about an interest expense? Companies with a long-term competitive advantage carry little to no interest expense. Let me repeat that again. Companies with a long-term durable competitive advantage carry little to no interest expense. Interest expenses give insight into how levered a company is. We'll talk more about leverage when we talk about the balance sheet in part 2. Typical interest expense ratios can vary depending on the industry, so keep this in mind when you're evaluating stocks. The author gave an important example in the book. So in 2006, an investment banking company named Bear Stearns reported that it paid 70% of its operating income on interest payments. 70% was not that unusual for investment banking companies, though. But however, by November 2007, the interest payments rose to 230% of operating income, a threefold increase. Bear Stearns went from $170 a share to $10 per share when it merged with JP Morgan Chase and Company. Gain or loss. Companies also have to report frequent income expense, such as the gain or loss that could be on a sale of assets other than inventory or the disposal of a business segment. A profit is the difference between the proceeds from the sale and the carrying amount on the company's book. The carrying amount on the books, which is also known as the book value, is what the company paid for the asset. This other line item could be things like licensing agreements, the sale of patents, impairment charges, write-offs, or restructuring costs. These unusual or infrequent items pose a challenge when we are doing financial statement analysis because management teams can decide how to classify operating items, or they may not clearly label unusual or infrequent items. So what that means is that these other expenses could be shown as separate items on the income statement if they are material, which is a gain on sale of assets, or if they could be buried within operating items. Materiality just means that certain financial transactions are included in financial statements depending on the size of a company. So a large company such as Walmart might think about this differently versus a small private company. So each company's internal finance and accounting professionals, with assistance from outside auditors, need to determine what would be considered material to that company's investors. What the small company would deem to be a material transaction could be viewed as immaterial by Walmart, for example. So all of these challenges actually create potential for manipulation and accounting shenanigans. So watch out for this. So how Warren keeps it simple is that he removes these infrequent or unusual events from the net earnings for a truer picture of what is happening at the company. EBT. The EBT is an important number to use to compare different companies and investment opportunities. So EBT is earnings before tax. Warren discusses the earnings of a company in pre-tax terms for this reason. The average income tax for a corporation is around 35% in the United States. Looking at the amount of income tax paid is a useful way to see if companies are actually making the money that they return. So all we need to do is take the earnings before tax and deduct 35%. And if the tax on the income statement is vastly different, start asking questions. Net income. Net income is an important indicator for companies with a durable competitive advantage. A ratio to look at is the net income divided by the total revenue. The higher the percentage, the better, because it can tell us a lot about the economics of the business compared to other businesses. A low net income to total revenue ratio can mean that the company is in a highly competitive industry. So Warren's rule of thumb is to look for a 20% ratio for net income to total revenue. So almost every income statement you look at will be different from the last, although every income statement will have the total revenue, the expenses, and net income. And technically, that's all required to be in the statement. However, the majority of the time, there will be additional little details within each section to give readers further insight into the company or organization's financial activities. So just be aware of that. But as long as you know the basics and the skeleton, you should be able to read an income statement. Earnings per share. When trying to assess the profitability of a company, you need to look at more than just the total profit number for the period. Under the total profit for public companies is the line that shows the earnings per share, or EPS. This is the amount of the bottom line revenue for every share of the company's stock. Earnings per share is the net income divided by the shares outstanding. Shares outstanding are all the shares of a company that have been issued and purchased by investors. However, Warren doesn't just look at EPS for 1 year. Warren looks at the EPS for a 10-year period to see if a company has a durable competitive advantage. He's looking at the 10-year trend and looking for a consistent upward trend. So any erratic changes, booms and busts, create an illusion of buying opportunities. The EPS is an important measure for individual investors because they know that it's the primary driver of the market value of their investment with the business. The higher the number, the higher the market value is for a public company, and the higher the book value per share is for a private company. So there you have it. That was the income statement in a nutshell and how Warren Buffett scrutinizes it. Is there something that still confuses you about income statements? Comment below. Once again, if you learned something, please like and share this video. Please also consider subscribing. It will really help us get traction so we can make more videos for you. So that was the end of part 1, and in part 2, we'll get into the balance sheet and cash flow statement. See you there.